Hello, everybody. Again, this is Hugh Johnson, trying to get you up to date, bring you up to date on what my thinking, our thinking at Hugh Johnson Advisors is about prospects for the financial markets and for the economy. I'm going to be talking a little bit about, what I envision to occur or what I think is going to happen in the latter part of 2018 and 2019 that might occur, but I think what's more important is we start with what I think is on the table right now in front of us, what I think is going to be the outcome between now and, let's say, the end of the third quarter of 2018. When we get beyond that, things might get a little bit more risky. This might sound like one of the gloomier forecasts that I've given you. It really shouldn't, because the short term really hasn't changed a whole lot. I know, and you know, that this has been a very long cycle, a very long bull market. We're at the 107-month mark. The longest bull market in the post-war period, 111 months. So I think very shortly we're going to have the longest bull market in the post-war period. It will not be the strongest bull market in the post-war period. We're up about 300% since March of 2009. The longest bull market was the 1990 to 2000 bull market, where we were up 399%. But still, this one's going to end up being, I think, in short order, the longest. At any rate, whether longest or it's the strongest, it's been quite a bull market, and we need to be on our toes looking for those signs that signal the end of the current bull market and tell us when we have to become a little bit defensive in portfolio to try to preserve capital. Preserving capital with us is, as everybody knows from all the letters and all the things we've said, is one of our strongest imperatives. On a short-term basis, looking at the performance of the financial markets, for the most part, the performance of the financial markets sends the same signal that it's been sending continuously for a very long time, and that is that investors are really sending the signal that we have further to go in the current cycle. You see that in the fact that the stock market, of course, has been up, particularly up since last August, the beginning of last August. Up about 12.5% since the beginning of last August. It's been a very strong market. In addition to that, of course, investors have been migrating to or buying the so-called economically sensitive bull market sectors. You see technology stocks at the top of the list. You also see stocks like consumer discretionary stocks, basic materials stocks, industrial stocks, all performing at the top of the performance ladder, and those stocks which tend to be defensive, which do well when market conditions get very difficult, when we might be headed towards a turndown in the economy. Those kinds of sectors like utilities, telecommunications, and consumer staples are at the bottom of the list. And probably the only outlier here is that large capitalization stocks, perceived ordinarily to be fairly safe things to buy in a market where there's some uncertainty, large capitalization stocks have been outperforming small and mid capitalization stocks, which is one of the reasons we want to overweight large capitalization stocks. Nevertheless, the performance of the financial market seems to be saying that we have further to go in the current cycle, and on a short to intermediate term basis, meaning through the first half of 2018, maybe a bit longer than the first half of 2018, we've got pretty much an all clear sign where that the stock market should be going up and continuing to reward us as investors. This is also consistent with the economic numbers, things like the index of leading economic indicators, which have been up 15 months in a row and telling us that the economy is going to continue to expand and give us the level of profits that we need to justify stocks at current levels. I know everybody, including myself, are very worried about valuations, but I think the tax cuts have added enough to corporate earnings, the outlook, the prospect for S&P 500 earnings for 2018 and 2019, but particularly 2018, to certainly justify the current level of stock prices. I would not conclude by a long shot that the market is overvalued and therefore has become somewhat speculative. So on a short to intermediate term basis, once again, very importantly, it looks like we've got further to go on the upside. We're in that period of time where things get really dicey. It's not only that the market has had a real long bull market and a very strong bull market, and you have to be on your toes. But interest rates are starting to head up. Interest rates are starting to head up, and sooner or later, as some of us have been at this for a long time, know that the good news of higher, stronger earnings, particularly higher, stronger earnings that have been driven in part, maybe even in large part, by the tax cuts that we saw that are going to be really effective in 2018, That good news is going to be offset by interest rates getting to a level which is simply going to put too much downward pressure on what investors will be willing to pay for those earnings, on price-earnings ratios, and that the bad news of declining price-earnings ratios will offset the good news of rising stock prices. I don't know when that's going to occur, but as I do the numbers right now, it's about the first quarter of 2019. We've got a ways to go on the upside, but as I say, in my judgment, things are going to get really dicey, difficult as we get towards the latter part of 2018, and beginning to start in 2019. We may then see a shift in the markets. You may see things happen, such as the so-called bull market sectors like technology and consumer discretionary will do less well, will be at the bottom of the performance ladder, and some of the defensive sectors, utilities, consumer staples, telecommunications will start to move their way up the performance ladder and start to perform near the top. So we'll see if these changes occur. Right now, we've got sort of, we'll call it the all clear signal, stay positive signal, and we continue to stay positive in our portfolios. But as you know, and as you've heard me say just over and over again, we know preservation of capital in a bear market that's accompanied by a recession is our tallest order, and you can bet we're going to be working real hard to look for those signals that tell us that we need to be defensive, and we'll be responding to them. Right now, we don't have them, but I wouldn't be at all surprised in the latter part of 2018 that we start to see them, and we might be heading towards a little bit more difficult times. But for now, we're just fine. I really appreciate, we all really appreciate all the confidence you've shown in us at Hugh Johnson Advisors. We are very open to any telephones, any emails, any letters, any telephone calls you can give us. Give us your ideas, your thoughts, things that you're happy about, things that you're unhappy about, concerns that you might have, and we'd be really happy to discuss them. It's really learning from people like you what's on your mind that we really are able to formulate or put together a really comprehensive and complete investment strategy. So let's say thank you for the good times. Thank you for the confidence you've shown in us. We hope there'll be more good times, but we're not going to be relaxed about it. We're going to be watching every day for those signs that tell us that, well, maybe we move a little bit towards defense. Again, thanks for your confidence, and look forward to talking to you all as soon as we possibly can.